Stock of the day, thought we'd take a look at Telstra. UBS, the broker, has upgraded its take on the telco to a buy rating from a neutral position. Telstra shares went up with total gains rising 10% for the year to date. Telstra shares. The broker says, UBS says, the upgrade reflects market sentiment, which is relatively rational on Telstra leading the market on price rises. Of course, the 1st of July, Telstra's prices went up 7.5%. The telecommunications giant said that was because of inflation. I'm not sure whether Telstra's costs went up that much, but is it one of the companies that the RBA has been targeting, saying that they're putting their prices up at the higher end of inflation, and that will just make inflation stickier to come? Look at that, Telstra share price near a 5-year high at the moment. Carl, what do you think? Do you agree with UBS's upgrade? And what do you think of the Telstra share price?
Do I agree with the upgrade? Well, look, they're doing very well. I mean, it's a very defensive part of the economy. You can get away with increasing prices by 7% and probably not get too much whiplash from the client base. So in that regard, inflation is a good thing for them. Hopefully they can't do it next year and in the year after that. So maybe this is a bit of a sugar hit to the bottom line. As far as the underlying business of Telstra, well, there's actually more growth in Telstra. It's more of a growth-oriented business than it has been probably for the last 20 or 30 years, Koshy. So if you look at what the brokers are saying, and these are not my numbers, these are Thomson Reuters numbers, they reckon we're looking at about 8% compound annual growth rate for Telstra, which if you go back, I've analysed Telstra, I've been in the industry for over 20 years, so I've analysed Telstra many times over that time frame. I don't think I've ever seen it with an 8% compound annual growth rate for the next 3 years. So that's quite extraordinary itself. Traditionally, investors have been drawn to Telstra because of that quote unquote high dividend yield, which isn't as high as it historically probably has been. It's around about 4% fully franked now, but it's still very, very attractive and reasonable growth. The only thing you need to do then is go to the next line, which is, well, how much am I paying for that growth? How much am I paying for that rather attractive dividend yield? And it's trading on about 26 times this year's earnings, which is not cheap at all. Historically, it's about par though, to be fair. Looking forward, you're paying about 22 times earnings as a median for the next 3 years. So to boil it down, 8% growth, which is about the market's average growth, for a PE of about 22, which is well above the market's average PE. The market's average PE right now is about 15. So it's hard for me to see value in the Telstra shares despite the growth. So yes, great growth, nice dividend, but I think you're paying too much for it here. The chart is good, however.
I was about to say, when you said, I can't do this, I thought, Carl hasn't mentioned the chart yet.
Well, I like to talk about the growth opportunities. So for me, I need to see earnings. I love growing earnings. That's what makes the price go from bottom left to top right. Yep. So that is where I do like to start. I want to then get it at a good price. I want to get those earnings at a good price. I'm not seeing that, and then I'll check the chart.
Right.
If I've got a great company and a great chart, tick tick tick, off we go. I've got a great company. I've got a very good chart. Look, I'm a holder. I'm a holder on Telstra. I don't think I'm a buyer just on that valuation. The chart is very solid. It's starting to turn over a little bit though. So it's not all green light from here. I would say be careful if it starts to trade below, say, 420. Then you might want to just take a little bit off the table because it has had a pretty good run. That's how you started this discussion. But as long as we stay above it, I think okay.
Okay. Michael, there is theory that companies like Telstra, when they report in August, that it will surprise on the upside because they've taken advantage on their margins, taken advantage of inflation. I remember back in the old days when inflation was just rampant. Okay, so this was back in the 90s, and I'm old enough to remember the OPEC crisis back in 70s and 80s. You could put your prices up 10% and everyone was conditioned to go, well, that's fair enough, inflation's high. Even if your cost didn't go up 10%, you could get away with a 10% increase. Are we seeing that a bit now? Because 7.5% price rise for the 1st of July is based on the inflation rate at the end of last calendar year and is sort of way above the 5.6% that was the most recent.
I think you're certainly seeing companies like Telstra who can get away with it take advantage of it.
And the Reserve Bank's calling them out.
And the Reserve Bank is so scared of inflation expectations because once inflation expectations, that's one of the biggest contributors to inflation. Once you're in an inflation cycle, it's really what people's expectations of inflation that really drive inflation going forward. So their whole agenda, the RBA, is to really manage inflation expectations because as soon as, like you say, people start to get in their head that 5-10% increases are normal, then it just feeds on itself. People accept it, and that's how you really get these inflationary spirals happening. So it's definitely something to keep an eye on. Can you blame these companies? I mean, they're true capitalists in the end of the day, looking to extract as much value as they can for shareholders.
Got to look after shareholders.
Extract. What a word, extract. I love it.
You know, but this is what well, Gav, this is what we're talking about now. Is,
the problem with Telstra...
Do you get your own back by being a shareholder?
The problem for Telstra is they've had 10 years of earnings in decline, pretty much, until recently. So you had earnings in decline, you had dividends per share in decline.
They re-engineered their cost base.
They've re-engineered their cost base.
The previous MD, had 2 5-year plans.
That's right. So now they're in the recovery phase where for the first time in a long time, they're able to see some earnings growth coming through. They're able to see some dividend per share growth coming through. And the market, to some extent, got excited by that because for the first time in a long time, this low risk business in a high risk environment is actually offering something that is relatively attractive compared to the last decade for this business. So it kind of makes sense why it's trading at 22 times earnings. I've been negative on Telstra for as long as I've been in the industry. And I'm not overly excited about it now, but I can see why a lot of people are. It's at a 5-year high, and I can see why the brokers and the big investment banks are all starting to get pretty optimistic on it because you can see that they're doing good things in the mobile market. They still dominate that market. Market share's holding up very well, if not growing, and they're able to get through these high prices. There's also talk of monetising some of the InfraCo assets as well, which can give them another sort of boost when it comes to earnings. But then in saying all of that, I'm more a hold on Telstra. As well as it's doing, there are still risks in terms of wages for them. There's obviously ongoing risks with some of those emerging players in the mobile network, and it's pretty expensive despite the earnings and revenue growth that's coming through and some of those dividend per share growth. So I'm more of a neutral hold on it. It's slowly but surely grinding high, but it's not that exciting. And I do think that when the worm does turn for the broader market, there'll be other pockets that do a lot better. Because although that chart looks very good, it's really only creeped 10% higher in 12 months. It's not like it's, gone parabolic.
Is this an unconscious bias from professional investors, do you think? That it's been around so long?
It will hold up well in the portfolio relative to other things if the market struggles, but 4% dividend yield relative to history is not that attractive. High multiples. It's not going to fall through the floor, I don't think, but I don't think it's going to take off necessarily either. It'll hold up and end in your portfolio.
Interesting discussion, though. That's good. All right.